If we break out of the current pullback in silver versus gold, which we argue is now commencing, we're starting to see the breakout, we're going to gush not only to the 2% level, which is to say almost double the price of gold and silver in relation to gold as it is now.
Yeah.
Okay. But you could go further because in bull trends, like in the 79-80 period or in the 2010-11 period, in the surge, the last 2 years of those bull trends, silver went berserk relative to gold on a percent basis. It ran way out in front of it. And the spread got up to like 3% or higher during those times. So that could mean a tripling of the price of silver at its current level to gold on a relative level. So yeah, we argue that silver and the gold and silver miners are now going to beat gold going in this next year.
Analysts at major financial institutions predict silver will reach $38 to $50 by year's end and peak at an even higher level over the next few years. The record-breaking rally in gold prices drives the current rally in silver, as the price movement of gold is often the rising tide that lifts all precious metals. Like gold, silver is perceived as a safe haven asset in this environment of continuing global geopolitical tensions and economic uncertainties. However, unlike gold, silver's essential role in electronics manufacturing and renewable energy technologies means that there is even stronger industrial demand. Founder and chief analyst at Momentum Structural Analysis, MichaelOliver, highlights that silver's ratio to gold is 1.15%, but past bull markets saw it reach 2% or higher. If history repeats, he suggests silver could double or triple relative to gold. Oliver predicts silver and silver-related investments will outperform gold this year. Given current financial conditions, he notes that gold has seen 2 prior eightfold moves, suggesting a similar trend could push prices above $20,000. Adding to this longer-term trend, the recent rally has resulted from uncertainty around U.S. tariffs and the developing trade war, which has been amplifying economic risks and market volatility, further driving investor interest in gold as a key diversifier. According to MichaelOliver, silver and miners are the top opportunities for 2025. If past trends repeat, he predicts miners could triple in valuation relative to gold, meaning miners could rise 9-fold if gold triples. Major miners' current valuations also suggest further upside potential. Gold mining stocks continue to offer growth potential independent of gold prices. Unlike miners, physical gold does not pay dividends or interest and cannot grow through business expansion or efficiency gains. Furthermore, Oliver warns that rushing from an infinite financial system into finite gold and silver could trigger extreme price moves. He predicts gold's next peak will be a permanent shift, possibly leading to a re-evaluation of central banking and a return to gold-backed currencies. Now, we present the clips of MichaelOliver's insights from his recent interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates.
Silver is alternately gained more than gold and then less than gold, ebbing and flowing over the last 10 years. Okay. And especially since 2024 in March, we put out a report arguing that the stall we'd seen in gold for a couple of years sideways was over. We're going up again. Okay. Well, we went from 2,000 to 3,000 during that year since then, a full year now. And silver went from like $25 to $35. A pretty good gain too. Okay. But there are times when silver underperforms. Whenever gold pulls back, silver pulls back more. Okay, bigger context. Silver's ratio to gold, we measure it by dividing silver into gold, expressing it as a percent, is 1.15% the price of gold now. 1.15. Okay. If you go back 50 years and look at the highest reading of silver in relation to gold, it was dividing the price into the ounce of gold, expressing it as a percent. 2% has occurred in 21 of those 50 years. Okay, so it's almost normal. We're 1.15. Okay. If we break out of the current pullback in silver versus gold, which we argue is now commencing, we're starting to see the breakout, we're going to gush not only to the 2% level, which is to say almost double the price of gold and silver in relation to gold as it is now.
Yeah.
Okay. But you could go further because in bull trends, like in the 79-80 period or in the 2010-11 period, in the surge, the last 2 years of those bull trends, silver went berserk relative to gold on a percent basis. It ran way out in front of it. And the spread got up to like 3% or higher during those times. So that could mean a tripling of the price of silver at its current level to gold.
Relative to gold.
On a relative level. So yeah, we argue that silver and the gold and silver miners are now going to beat gold going in this next year.
Hmm.
And personally, that's where I'm invested, is
Okay.
with the emphasis in those areas. What we see with the miners is the same thing we see with silver. We see the technical dynamics of an upturn. In fact, we're on the cusp right now, this month, of posting a close where you measure GDX, for example, versus gold, or the XAU index versus gold, and we're registering a breakout, meaning the performance breakout is occurring. At that point, we expect the miners to beat the pants off gold, as they do periodically. And I think this is in part also due to the breakage of the stock market, because a lot of people in the stock market, when they exit, they're not going to go out and buy silver futures.
Indeed.
Okay. They're going to buy stocks. And frankly, the gold mining stocks in relation to the S&P, gold mining stocks in relation to gold, are vastly cheap and have not gone lower in terms of relative performance. If you go back to 2015, when they were bombed, net price, but also relative performance of the miners, they've never gone lower than that. They've been higher than that level for the last 10 years, meaning the miners, despite the fact that they're not above the 2020 price highs, are actually up more on a percent. XAU index, for example, is up more on a percent basis from its bare low in 2015 than is gold. Tell somebody that at a cocktail party and they'll spill their drink. But it's a fact. They're actually, the XAU is up more than gold is over the last 10 years. And we think it could rush to the upside. We think the potential there is for a tripling of the valuation of miners where they currently are to gold to where they could be over the next year.
Okay, so that's not a tripling of the miners. That's a tripling of the miners
Tripling of the relative level.
relative to
It could
gold.
be, yeah. I mean, if gold goes up another threefold, let's say, miners will go up, ninefold.
Gotcha.
Three times the amount of, et cetera. You get the point. So we think that the dynamics are for silver and the miners now, and that's where I'm personally viewing 2025 as being the best place to be.
In this eye-opening interview, MichaelOliver reveals why momentum signals a dramatic shift in precious metals and the broader financial markets. Despite periodic pullbacks, he predicts that a stock market collapse will trigger a rush into gold, accelerating its rise. This influx of capital could also push central banks into drastic action. A ratio of the S&P 500 index in terms of gold has dropped to its lowest level since the pandemic, highlighting a preference for safe haven assets among investors and providing a warning sign for the U.S., as well as the global economy, according to a strategist at State Street Global Advisors. Major gold breakouts typically occur shortly after secular peaks in the stock market, creating a pattern that is repeated throughout modern financial history. This relationship becomes clear when examining specific historical examples. Research from the World Gold Council confirms that the precious metals market historically performed best during secular bear markets in U.S. stocks. During the 1970s, while the S&P 500 delivered negative real returns, gold produced average annual returns exceeding 30%. Regarding the current stock market bubble, Oliver warns it is the largest in U.S. history, driven by artificially low interest rates and excessive debt. Central banks will intervene when it bursts, but the fallout could surpass 2008. Let's get back to the interview.
When you look at annual momentum of gold, and that's when you measure the monthly price action in bars oscillated against, let's say, a 3-year average or a 36-month average. You get a long-term momentum trend picture. That picture turned down in late 2011. The market wobbled around for a year and then collapsed. Didn't make a new high after that, by the way. And then it went down to 2015. And ever since December 2015 low, when it turned up as of February 2016, by our metrics, by using annual momentum, it has not negated that. In other words, we've had plenty of stalls. We've had pullbacks. There was a 20% pullback in the 2020 to 2022 low, for example. 20%, if you consider that major, you had one. But it didn't break the major uptrend in gold, the momentum uptrend. Scared price people all along the way. You've scared all the price folks out, in and out, in and out. And that's the top. Oh, no, et cetera. And for some reason, because we're humans, I guess, round numbers catch people's attention.
Indeed.
Remember the trouble just over 2000. For a couple of years, we get over 2000, they'd sell it. They'd sell it. They'd sell it. That's not the way you top a market. You don't go back to the high again. If you do, it says you're going through. Okay, well, we finally went through. Now we got 3,000 crowd. Okay, just like we have the $35 crowd on silver. Okay, and which we've been to twice now, by the way. So I think this is merely another pause point. And I think the key factor for gold has been for recent months the need to break the stock market, U.S. stock market bubble, because when you punch a hole in that beast, the money will flow elsewhere, and historically it has always flowed into gold. Not that gold waits for that. After all, gold's been going up anyway, right? Okay. But it helps infuse the dynamics of gold because it creates a river flow of new assets that are seeking safety. And I think we're already starting to see that now with the topping of the stock market. And I think the next phase up in gold will be fairly dramatic because the flow from that asset, broken asset category, will enhance it. It will also spark the central banks into craziness again. I don't know, except to say that it's just going to be monstrous because the bubble itself is the biggest bubble in U.S. stock market history in terms of number of years up, causative factors like M2 growth, Fed funds rates being off the page cheap for 10 or 15 years, and even for the 15-year period when they raised them briefly, those levels were still historically cheap. So they kept money, the price of money, artificially low, and that created false investment, false notions of trends. And when you do that over a span of time of 15 years, you create a lot of errors embedded in the economy, embedded in personal debt. When it breaks, the central bank will try to come in and rescue it, as they always do. You go back and look 2000, 2002, 2007, 2009, they cut rates like maniacs and did not stop the breaking of the bubble. Once it breaks, reality takes over. Problem is, this one is a monstrous bubble. Therefore, its consequences could be, in the real world, very, very bad, much like 2009 was. Even if you weren't in the stock market, 2 years after that market topped, 2007, by 2009, most people in the street were feeling the pain. And this time it should be far worse. It's not just going to be the breakage of the Mag 7. We're watching in particular commercial real estate, which is a debt-laden sector, highly vulnerable. And obviously, if it breaks, as we expect, and it is doing so, it will impact banks. You do that, the central banks go crazy.
Considering all these factors and surprisingly low premiums on bullion products, as demand has not yet caught up with the rising spot prices, there is an excellent opportunity to buy silver well in this market. If silver reaches past bull market ratios to gold, could it surpass its all-time high and enter a long-term revaluation phase? Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the following video.